Hey everyone, we're here for our next session, which is on the anatomy of an early ecosystem. And I'll let Kendall take it from here.
Hey everyone, my name is Kendall. I am a co-founder of a company called Proximity that focuses on the DeFi ecosystem for Near. So we do a mix of a grants program, and then we also build applications, DeFi applications for Near. And I'm here to talk a little bit about how early DeFi ecosystems develop on new L1s and really L2s even. I'll be giving a bit of kind of the perspective from a member of the Near ecosystem, what sort of happened with our chain, and trying to talk a little bit about, some of the things that we've seen both across, our ecosystem and its development, but also other ecosystems such as Solana, Avalanche, Arbitrum, Polygon, and more. So yeah, let's get it started. So just a little bit more about kind of what we'll cover. So as I mentioned, talking about the emergence of these new ecosystems. I'll touch a little bit as well on some of the advantages that early ecosystems have. It's very clear that there are many disadvantages, maybe even more disadvantages than advantages, but there are some things that early ecosystems can kind of leverage that much bigger, more mature ones, specifically Ethereum, doesn't necessarily have as much anymore. And then I'll also dive a little bit just into some of the specific projects on Near, just to kind of give more of concrete examples of what these projects can look like and what they're doing. So what makes a healthy DeFi ecosystem? There's certainly a lot of components here. I think there's three major aspects. So the first one is capital, and we'll touch into a little bit about what that is and how that differs from liquidity. Second, as I'm sure many people are aware, and this is really where Ethereum did a ton of just kind of groundbreaking, is these core components, these critical applications and building blocks, and then also primitives. And then this third major component is liquidity, specifically on chain, and we'll talk a bit about how that breaks down. So capital. What I mean by capital is basically assets that have a well-established price and that do have some sort of liquidity. I think what's really important to distinguish here is that oftentimes this liquidity will actually be off-chain. If we look at kind of with the minimum sort of requirement for capital is some sort of liquid-based token. Bitcoin being the best example of this. There's essentially no activity, although maybe starting to change with certain projects, activity and liquidity that actually occurs on Bitcoin itself. But there are insanely, at this point, liquid markets for the Bitcoin itself, and so that's led to you can essentially measure the capitalization of Bitcoin based on what is the current sort of outstanding number of Bitcoin, and what is that price. And you can think of that as kind of capitalization, as opposed to a more common DeFi metric as total value locked, since there's not really necessarily anything to lock it into, although that's slightly not true. Ethereum evolved in the same way, right? Even though it is a chain that has been designed to issue new assets and do a lot of new things, create these new financial products. Initially, it really was just Ethereum trading on Coinbase as the capitalization on the chain, and we went through a similar evolution as well at Near. So yes, this early capitalization, usually off-chain, usually on centralized exchanges. I think where the game really started to change, and what's become, has really made capital on-chain and capital as sort of a concept way more interesting, was the ICO boom on Ethereum. This is really where the capitalization, this is sort of the catalyst for capitalization on Ethereum. All these projects that were, some of these ICOs, or a lot of them were on-chain, but the markets, up until really Uniswap, even though we had Ether Delta for a bit, but the liquidity was very, very light, very nascent. Really most of this trading activity still took place off chain on Binance, which kind of arose around that time, and others that were pretty aggressive with listing these early Ethereum tokens. And now how things have really changed, and this is true for pretty much every L1 and L2, is that a lot of the important capitalization outside of that base token happens through bridges to Ethereum, now bridges to other chains, as we've seen, Binance, BSC really arise, Polygon, and others. But it's still mainly these bridges to Ethereum, where you have the base asset that has some kind of, liquidity, probably off-chain and also on their sort of first exchange. But the rest of the assets, and really the long tail, at least for the first couple of months, comes from bridging these assets from Ethereum. So just to give a little perspective on Near, and we sort of touched on it a bit there, but yeah, when Near first launched for a while, the real capital of Near was the Near availability on a few centralized exchanges, which arose, pretty much listed Near essentially the second the mainnet went live. And this is also something we've seen with, Solana, Avalanche, et cetera. It's become, fairly common practice. The Near community launched what's called the Rainbow Bridge, which is a, trustless bridge to Ethereum with expansion plans to Polygon, BSC, and more. A very important aspect that supports any ERC20. And so what we've already seen is, hundreds of millions of dollars have kind of moved between the Rainbow Bridge from Near to Ethereum. And we've seen, particularly ETH and some of these major stable coins like USDT, DAI, and USDC that are being used in your application. So just representing that this is, an important way that this capital kind of forms. And interestingly, this almost comes later now, because it's so, at least the path to, launching some kind of on-chain market maker, automated market maker, or some kind of decentralized exchange is a lot clearer. The kind of availability of these native tokens that arise on a chain, that only exist on this L1 or L2, or at least start there, and then being listed on these centralized exchanges, that actually tends to come after kind of the bridging, which is sort of an interesting shift that's happened, and I think a very promising one. So that's how capital works in the formation of these early ecosystems. This is probably even more important, but often starts to happen a little bit later than the initial capital formation of the base chain, is these core components. So there are core components and there are primitives. I do see them as kind of the same, but we'll sort of break them down as to more applications or protocols and primitives. Primitives being more, really standards is a good way, I think, to think about it. So token standards are key. The development of ERC20 and the extension of many more types of token standards on Ethereum were a prerequisite for kind of these token booms. So new chains have to develop their own token standard. A lot of times they do take a lot of influence from ERC20 and ERC721. But I think the teams that are doing it the best are actually thinking of, what do those standards not actually do well? And, there are the many standards that have come after that have seen less adoption, but, how can we apply those and make those actually more standardized and more native to our chain? Something that gets talked about a lot less as a primitive, but from speaking with a lot of teams that are looking to go multi-chain, is this has become pretty important for just about every single new project that's launching in some way, at least for a time being. I know there's a lot of criticism here, but multi-signature wallets and accounts, the ability to distribute control even in where you still have the core team that's really has a lot of ownership over the direction, at least the technical direction, if not also the treasury. This is really important, just as a way to move quickly. And so it's pretty important to have this on your chain as quickly as possible. And these early ecosystems have either engaged with these teams or developed their own standards. DAO is probably not a surprise to anybody here, and really the sort of better evolution of a multi-sig wallet, or at least the one that's a bit more community driven. You're having some kind of framework, as whether it's as a primitive or whether it's its own application, is really key. And then liquidity mining. And, I think SNX or Synthetics really kicked this off with their kind of, their sort of standard liquidity mining contract that's been reused by many, many teams now. Just having an understanding of what that sort of looks like. And, on an EVM chain, it's easy. You can use that same contract or use one of the many that are there, for Near, for Solana, for Polkadot, and for Terra. This is where that primitive needs to be established. And, whether it comes from an early team or from the core team, having some kind of pattern, some kind of contract pattern on how to do this and some best practices is a really key primitive. And then here, just talking about the components and applications, probably not a surprise to many of you that are deeper in this space. But if you're newer, these are sort of what I see as like 5 of the building blocks. These essentially have become a dependency for many, many of the projects that are building. And what's amazing about that is that, it means they don't really have to reinvent the wheel to implement these things. So DEX is, primarily the automated market maker, for liquidity, is a core building block for just about any project these days. An Oracle, to the criticism of many, is really key. And that next building block there, lending, of course, has the dependency on an Oracle, on a reliable price feed, and like some kind of like safe data that you can get onto the chain from off chain. As we kind of talked about before, bridges really are one of these components. If you want to be able to access that capital and not have to go through your own sort of ICO boom, which does take time even if there's a lot of attention and a lot of projects building on your chain, that's, that is definitely one of the slower ways to go. And so bridge is really key there. And then one that probably doesn't get enough attention, but you'd be shocked, I think, to find out how many projects have the graph as at least a dependency for their front end. But the ability to index data on your chain and just, access that information without, essentially querying nodes for this information and then composing it, that's pretty key, and it just allows teams to move really quickly. And just a quick overview of some of the other ones, native stablecoins being really key, but one that probably gets a bit less talked about, but is emerging, especially as a core primitive for any proof of stake chain, is this idea of liquid staking, where people can both stake and secure the network, but then also receive some kind of token representation of that stake value that they can then use in DeFi, both compounding their rewards and adding to the the rewards they can earn, but then also removing that choice of, do I secure the network or do I go earn yield in DeFi? You no longer have to do that, and that's becoming key primitive. Aggregators like 1inch and, particularly these auto farmers that just take away a lot of the kind of, price discovery work and the kind of, price efficiency work, but then also just the, the overhead of having to, rotate your crops, so to speak, that there's add a lot of value there, even despite being, a second order option here. Derivatives, I think many of us believe, are kind of the next frontier in DeFi. They really do pretty much all sit as have dependencies on some of these other ones, like, lending, oracles, indexes, but those are pretty key. And then price discovery, without a doubt, does play an important role here. The many token launch pads, IDO platforms, etc. Just making it easier for teams to go to market and kind of establish some kind of early price discovery. And just to kind of give you guys an idea of, like, this is what we've seen from the Near ecosystem. It fits, these are essentially the first, 8 projects in the DeFi space or a DeFi adjacent space that have launched on Near, and they fit pretty neatly into some of these core components because, these are essentially hard requirements to really unlock those next levels of DeFi. So, we have a few AMMs, there's a lending protocol, Flux, which is a really exciting Oracle solution, liquid staking and Metapool that I think we launched pretty early on in the life cycle, which hopefully we can have that stake Near be an important part of the early future of DeFi on Near, price discovery, and then DAO frameworks. So this last kind of part of this like triumvirate of what is going to lead to these early ecosystems really forming is this on-chain liquidity. Unsurprisingly, a lot of these core components are going to play a big role in this. So I like to think of the path to on-chain liquidity as a kind of the pre SNX and especially comp. He really popularized the kind of liquidity mining model, and then the sort of post SNX comp periods. Even though pre some of these options still do exist, things really changed at that kind of like pivotal moment in about April of 2020. So pre SNX and comp, there's a few different ways that you could really bring on-chain liquidity, and Uniswap is a key player in this. But I guess the easiest thing to do, but also the very capital intensive thing, is to provide your own liquidity as a new project. Whether that's as the base layer, if you're Near, if we wanted to kind of do this, we could put up Near and maybe even put up our own USDC or ETH or something. A very expensive way to do it, but some way to kind of make an early market and then let price discovery just kind of happen as it does. Certainly listing on a centralized exchange is a path here, but one that can be very time consuming, and there's a lot of integration work and things to go into this. It's certainly not necessarily the easiest path, if it and as I mentioned before, has definitely moved late in the cycle, post SNX and comp. Working with market makers, this is certainly a common thing to do. Definitely for a long time has really been more of something you would do on a centralized exchange than something that you would do on a decentralized exchange. But market makers have started to move on chain, as well as those markets have in some cases even exceeded volumes or liquidity on centralized exchanges. And then IDOs being a one way that you do it. You just sort of put up your token with not very much liquidity and then just like let it sort itself out. Definitely not a recommended way to do it, but was one of the options and something that a lot of teams experimented with pre-comp. And then of course we get to this pivotal moment when Compound launched their token. They really demonstrated the power of the SNX style liquidity mining movement, saw themselves become, the highest total value locked protocol in DeFi for quite some time, and proved out this model that really kicked off DeFi summer and a lot of what the market and the ecosystem looks like today. So that's liquidity mining. That's these pool twos. A path now is you basically create a pair with your token and ETH or whatever it is that suits kind of your model, and you throw essentially the highest liquidity rewards that you can at it in order to just essentially establish kind of some value for it, some kind of like reason to own this token and create a little working market. It's a very expensive way to do things. And it is very much a short-term play, which is why we've seen some teams who have experimented with new ways of doing things. I think Olympus DAO and OHM have seen some serious success with their what they call a bond mechanism. Really, what that is just trading the token for to buy up LP tokens for your pair. So in their case, I think it's OHM and DAI, or also OHM and ETH, and that's essentially allowed them to buy their own liquidity. So they're essentially buying the liquidity for their own token, which is great. I think I think the Olympus DAO owns like something like 97% of the liquidity on Sushi for their tokens, which is powerful because it's when it gets to the close to $100 million, that's pretty liquid. It's going to be price movement is still going to happen, but it does create a lot of power for your protocol. And then even newer models that are sort of arising is what I think people are starting to call liquidity as a service. It's the way at least I like to think about it. And Tokamak being one that's really popularizing this, and there's a few that are coming. And this is essentially where you create new roles of some kind of token director, some kind of actor that teams, these early DAOs can work with, can almost pay in a way to buy liquidity or at least reserve liquidity for their token in the early days. So at Tokamak, you can kind of lend out your token to the Tokamak DAO, and then recruit these pools of USDC and ETH and other pairs to kind of provide the other half of the liquidity on an AMM. And you can do that for as long as is kind of necessary for your project to kind of just build up more natural liquidity as price discovery happens, as the market sort of understands what value both your token and your project are bringing to the ecosystem. And yeah, that's kind of how things have evolved. So that's to kind of sum up, capital, these core components, and liquidity as sort of the three prerequisites and some of the paths to getting those that early ecosystems have. So let's talk a little bit about what are some of the advantages of early ecosystems. Obviously the disadvantages are, none of those previous things have happened yet, and they do take time. They do take, effort. They take a lot of community building, a lot of, a lot of BD, a lot of different aspects, and just the technical implementations of all those things. But where are these early ecosystems, like where can they move faster? What can they do a little bit better? I think one of the major things, one of the most important, is these learnings from sort of our elders. There's a great tweet the other day talking about how the Solana ecosystem was kind of speed running what happened on Ethereum. But the reason they can do that is because we have the learnings of the last 6 or so years that Ethereum mainnet has been live, and what's worked and what doesn't. Especially in these three kind of areas, the primitives and the core components. The ones that I just laid out, Ethereum really paved kind of the way from that, and so we can learn from that. And the chains that probably inevitably arise in the future, more L1s, L2s, whatever layers they might be, are going to be able to even learn from the second wave of L1s and L2s on these primitives and core components, especially for the EVM compatible chains. Just the open source code, all of these great projects that have already been built that essentially can just be repackaged and redeployed. And not even just that, but also you see a lot of teams have been really aggressive in moving multi-chain, especially Sushi, Curve, Aave to some degree. They can just go ahead and deploy, and so that definitely makes a big difference. And then assets, that access to assets. We talked about the bridges. That wasn't an option for Ethereum. They had to create these new assets. Now you have billions and billions of dollars worth of assets that can simply bridge over, which is a pretty easy way to go about it. I think another really, really undersold part, but it's kind of interesting, and this was an advantage that Ethereum kind of had really did have in the early days, and it certainly hasn't gone away, but it's gotten a little bit more difficult to navigate as the ecosystem has become so big, It's just this collaboration between the community. You know, in these earlier ecosystems, you know, like in the Near community, there's less people, and so it's just easier for everyone to kind of know each other. That can make integrations easier, just because there are less projects to integrate with. There's, you know, less options, which you know, I think long term, you don't want that. You want competition. You want these teams making each other stronger. You want there to be a lot of opportunities. But in the early days, it makes it easier to just kind of establish these cohorts and these, you know, groups that work together. These personal relationships are easier to come by, and, you know, the ecosystem can really know each other. And that leads to this kind of, you know, we're in this together. We're the early adopters. We see the same things. We have the same values. This kind of squad mentality that, you know, really dominated Ethereum in the early days, and certainly hasn't left. But you know, as it's gotten as big as it has, you know, it's hard to maintain that. And it becomes, you know, they become like, whether it's cliques or just kind of, you know, like groups that, you know, will splinter off. And that's important for that later stage adoption and for, you know, ultimate success. But, you know, that is something that sort of goes away, and these early ecosystems can maintain. And then just less noise. There really are, you know, there's less projects, there's less, you know, it's sort of clear where the value lies, and, you know, who's good, who isn't, you know, who's really in this for, you know, for the long-term success, who isn't, who's just trying to get in for a little while. So this collaboration opportunities are pretty key. And the wealth effect, you know, this is something that really happened on Ethereum. You know, the early projects, you know, they met each other, they invested in each other, they worked together. And, you know, as that ecosystem has absolutely exploded, you know, that yeah, that allows these early adopters to then reinvest in sort of the next phase, the next wave, the next cohort of, you know, builders, dreamers, doers that are coming up. There are just clearer opportunities for the early adopters. You know, as we're launching, right, you know, we talked about those core components. Those are clear. Somebody's got to build them. Those are almost obvious wins to some degree. I mean, you know, the long-term success requires a lot of, you know, actual innovation and community building and these things that are hard to do. But, you know, it's, as we've seen with these ecosystems that launch, and, you know, particularly the dexes that launch, whether that's, you know, something like Saber and Radium on Solana, or, you know, Pangolin and Trader Joe on Avalanche, or QuickDex on QuickSwap on Polygon. These are they're gonna get attention. You know, you have to capitalize on that attention, but the attention is very clear. So while there is higher risk, it certainly is, but at least what's going to build and what's going to work is much clearer. And then, you know, as these ecosystems develop, for a while there really is kind of less competition, and, you know, especially after you have this first wave of, you know, wins to some degree, it becomes clear that there are some big returns that are possible, and, you know, this inspires a lot of new teams to come in there. And so, you know, this is what I think of as the wealth effect. Is, you know, people come in, they do well, they want to reinvest. The next wave sees people doing well, they want to get in. Then same thing happens to them, and that's how you can kind of, you know, really build up this this early ecosystem in ways that are harder to do on these more mature ecosystems. Cool. So let's dive a little bit into some examples from Near. You know, specifically just going to touch on a few projects that we've seen, and, you know, why we think they're exciting, and you know, essentially, like, how do these ecosystems develop? You know, the first one, unsurprisingly, is an AMM. It's called Rev Finance. I think what they've done a little bit differently is they've tried to immediately build in support for multiple curve types, so you can have, you know, whether it's you know, the classic, you know, constant product type of market maker, whether it's, you know, more of a stable swap type of product, that's also possible. And then you can also have, you know, the sort of balancer style, you know, 80-20 pools, or, you know, different weighting pools. And it can support trading across all of these pool types, which is, you know, kind of interesting. And certainly Rising is more of a way of doing things, but it wasn't really possible before. This is, yeah, one of the first projects that we saw that really had a lot of success, and just because it, you know, it plays really heavily into, I think, what both capital core components and liquidity as, you know, the key highlights of these early ecosystems need. So it pretty immediately just unlocks a need, which is, you know, why it was able to get some early success. And, you know, it's certainly like the way that we see this happen a lot on these early ecosystems. Another one that I think we're going to see be, you know, a core part of just about every proof of stake chain, and also I think, you know, start to arise earlier than it has been, is this, you know, this liquid staking. I think you could even argue that this is the first application on ETH2, with Lido launching. You know, they do have some sort of role on ETH2, even though you can't actually deploy contracts there yet. They've been able to, you know, work with a creative multi-sig solution to launch, and we have Rocket Pool coming soon as well on the Ethereum community. So, you know, I do think that that's going to become more common, that you're actually going to see these liquid staking protocols being one of the earliest. And this is exactly what we saw with Near. So Metapool is like liquid staking on Near, like we said before. Stake your Near, get this ST Near token. That ST Near token accrues value to represent your staking rewards and can be returned for your staking rewards and your base Near at any time. But you can also go and use it in DeFi. So this is going to be super interesting to see, especially on lending protocols. What you're going to be able to do there. And we'll talk a little bit of project that we're working on that's doing that in a second. Within a few weeks of launch, it started to get some pretty good traction. 3 million stake Near. It's over 20 million worth of total value locked, and some pretty substantial unstake liquidity. And that unstake liquidity number has grown to, I think, close to almost 2 million Near now. And so it has really blown up. And the first application we have of that being used in your DeFi is this ST Near to Near pool on Ref, which has been pretty interesting to see. Another one is Skyward. This is kind of that token launch platform we had talked about. I think what's cool about what we've seen with Skyward is they were really focused on price discovery and more fair price discovery. So it's actually set up as kind of a block by block auction over a certain period. So most of these teams have used 7 days, and so that provides a lot of benefits to people who hear about this later. Is that they have quite a bit of opportunity to get in, or even get in or get out, depending on where the price is. And I think what's interesting here is we've seen less of that massive pops as soon as the auction ends, but more just like a gradual kind of growth, as the project sort of grows more naturally, which has been pretty interesting to see, and I think is a good sign that the price discovery is somewhat efficient. So this has been important, basically, just to help these teams kind of go to market without having to do an IDO. That if you directly list on Uniswap, I think we've seen that advantages some people and disadvantages others, which is less ideal if you're trying to build for the long term and build up a big community. Another project, and this one actually is getting announced this week, is going to be the first lending product on Near, called Burrow. And I think what's exciting about this project is they're really focused on these interest-bearing assets. So the benefit of having a liquid staking derivative that's live early on the ecosystem in ST Near is that this can be used as a key collateral early on in the launch of this lending. And that's going to lead to something pretty fascinating, like a self-repaying loan. So Alchemix kind of, really innovated here with this self-repaying loan. I think we're, with the advent of these interest-bearing collaterals, especially the ones that have large liquidity like ETH and using Near and others on other markets, is going to be a fairly safe collateral to use in these products. And it's very advantageous to be able to borrow against your asset that's still earning more yield. And you can do something like a self-repaying loan where you can essentially borrow against your future yield, which is pretty fascinating. So just briefly, I'll touch on Aurora, and then we're gonna open it up to questions. So Aurora is the EVM on Near. It essentially is a smart contract, a Rust smart contract, which is pretty fascinating. But it allows Near to be fully compatible with the EVM and with all of the tooling and wallets that come with that. So very soon you're going to be able to use Near-based products with MetaMask, with Wallet Connect, Trust Wallet, and et cetera. And you're going to be able to pay for gas in ETH, which is pretty fascinating. So essentially what we've seen arise is we have kind of the native Near ecosystem and soon to be the Aurora ecosystem. On Aurora, you're going to see projects like Trisolaris, which is going to be the first DEX on Aurora, which will be the first time you can actually use MetaMask and all of your Ethereum assets very easily on Near, which is really exciting. And very, very soon, you'll see a lot more of these Ethereum projects that are moving over, these multi-chain projects in some of these arenas. And I think that's going to be pretty exciting and be a little bit more similar to the way things have kind of developed on some of these EVM compatible L1s. So yeah, that's what I have for you guys. So I'm happy to answer any questions. As I mentioned, I'm the founder of this project called Proximity. If you're interested in DeFi on Near, we publish a lot of information about what's happening there. So if you'd like to kind of follow us and just see what's happening, there's usually a pretty good stream of information that'll be coming down the pipe. All right, so do we have any questions in the chat? Ooh, stay with this. Yeah, shit.
Would you mind sharing the slides, either on Twitter or in the chat?
Sure thing.
Cool. And maybe your Discord link would be good. So that way, if they come up with other questions, they can ask you there.
Yeah, let me get that. All right. Ooh, sorry about that.
Yeah, it's tricky.
Yeah. Oh, here we go.
All right. I think he may have dropped. Are you back? All right. I think he has dropped. We're going to transition to the next talk now. Thanks, everyone.